The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello and welcome to the Become a Pro course. Of course, we have Forex.Academy here ready to jump in to our understanding of economic data. Very, very important, of course, for financial traders to understand the news flow and economic data, how it affects different assets. So once we understand the complexities of economic data, we'll be better able to disseminate news and obviously trade as such. Now, just before we follow on today's lesson, please follow with the disclaimer. There is risk inherent trading the financial markets, so do be aware of the risks involved. And as always, just a few pieces of housekeeping before we begin. Feel free to ask questions throughout today's webinar. It is a totally live interactive webinar, of course, so if you have questions, you have a chat box there located on the right hand side of your screen. Please do not hesitate to ask questions throughout. This live webinar is being recorded and will be placed into your members area once we have concluded. So if you could just give us a 1 hour grace period to upload it, you'll have it there for revision. And of course, with this particular lesson, it will be quite heavy in terms of the economic data flow. So I would advise you, of course, to revise this to get a further grip or knowledge on properly understanding what economic data means in terms of pricing that in as a trader. And of course, we have a Q&A session as well. So if you'd like to write some questions down during the course of the webinar and save them to the end, that's absolutely fine. We will be able to take 15 minutes to address all of your questions there towards the end. Now, of course, we're on webinar number 7 here with, webinar number 8 with economic data flows. And of course, we are looking to examine all potential market moving data and their effect on regional and global markets. So first of all, let us define economic data itself. As economists, it's very important to gauge the level of performance in both the global and local macroeconomy. Economic data provides major macroeconomic indication to the overall economic activity in the domestic economy. Okay, so that is going to be your main complexity if you're looking to trade one specific market, perhaps your local economy. If you're in Switzerland and you want to trade the SMI index and the Swiss franc across other pairs, perhaps you'll need to know, evidently what prices these assets, with relation to movements in your own economic function there. And of course, in the domestic economy, it's very important in terms of important business and financial sectoring. So that's the question, of course. Okay, so I should pay attention to the business cycle. That's a given. What type of cycle are we in? Are we in a bullish economy at the moment? How is the economy progressing? But how do I know which direction it's going? And then look, that's of course very difficult to find out. Predicting the business cycle is difficult at best. Often the economy does not do what economists expect. And you'll see that from day to day as economists price in their expectations. They provide expectations to the financial markets. And then when you see certain figures released to the markets, they're often a beat or a miss, which we'll discuss throughout the course of this webinar. Looking at various indicators give economists give them a feel for what is going on and an idea how to prepare for the future. There are some long-run trends in the business cycle that can help economics predict what stage the economy is currently at and where we are heading. Of course, and it's quite difficult. It's a difficult pursuit, of course, if you're a fundamental analyst pricing in these moves into the market. There's often a quite common joke in terms of economic circles. There are only 2 economists in the world knowing where the economy is going at one stage, and they both disagree. So that is certainly the case for trying to price in economic data. In the long run, more specifically, and you'll see expectations being beat on a daily basis in terms of the Forex markets trading. If you've ever consulted a Forex calendar, of course, you have a wide plethora of data to go through during the course of the day, again, which we'll discuss. So the fact that you can learn more about this and learn more to properly price these moves into the market, of course, on a fundamental basis, will allow you those opportunities. So in terms of the economic data that we'll be looking at today, we'll be looking at quite a lot. And of course, we'll divide them into three main areas of interest: price data, consumer sector data, and business sector data. And of course, like everything almost in the financial markets, they are all inextricably linked. So why is economic data important? Why is it important to us? And what we've done here is actually just take a section out of a potential traders' trading day. So there are traders who actually involve themselves. They sit down with their trade screens early morning, get a cup of coffee, relax into the trading day. They watch the European markets open, and the first thing they'll do is get up a Forex Factory calendar, or an economic calendar of the day, to look and actually see what news flow is going to be presented in terms of asset class across different countries, of course, and particularly if you're a Forex trader, what is going to affect the volatility midday or intraday in the Forex market. So this is a typical day in the life of a trader. We get up Wednesday, the 2nd of May, there not so long ago. We have, of course, quite a large number of economic data being released to the market, and we can see some green figures and some red figures respectively there on the left hand side, where that indicates within here that effectively some of this data has been a beat perhaps, or a potential miss in the markets as well. So given those expectations, of course, we're likely to see strong moves in the markets. Again, volatility is our friend, but this is a typical day in the life of a trader. How may it help us as individual traders? Well, as traders, we are constantly positioning ourselves for new volatility to enter the markets. That's a given. Market prices will change as a result to new economic data. The flow of capital and investment will change as a result to changing economic conditions. Okay, so that's certainly the case. We discussed there 2 lessons ago the flow of international trade capital and how markets can move as such in terms of defining long-term fluctuations in currencies. That is certainly the case. In defining long-term capital investment in certain equities or companies, of course, that is the case. So the flow of capital and investment will change as a result of changing economic conditions. And if we are to consult our day in the life of a relative trader here, he may be making, of course, he or she may be making trading decisions based on some news flow that may come out during the course of today. Long-term traders gauge a better idea to the economic fundamentals of their trade positions or trade ideas. That's certainly the case. So if they're in a trade position, perhaps they're long, the equity indices, and we're seeing relative growth in those indices, more supportive economic data will, of course, support his trade. Potentially, if he's not in a trade, he or she may like to involve themselves in a particular fundamental market that is moving as such according to economic data. And short-term day traders and speculators can involve themselves with profit opportunities as the markets move in tandem with reflective data. And that is certainly the case. I know quite a few traders that sit down at the course of the day. They consult their economic data form to see what is currently happening during the course of the day, if there's any significant changes, perhaps in interest rates, or if there's data in terms of the amount of bonds released to the supply system there in the UK or Europe, if it's crude oil inventories, which we can see on screen there, a very, very popular figure for oil traders, usually around Wednesday at 1:30 each week. It's a weekly figure that you can get used to. You know the supply function of the oil market, and you're waiting to see how much supply is actually stored in Cushing there, Oklahoma, United States, for WTI oil. That is, of course, a popular trade for many oil traders. So what is our role as traders? Of course, again, to bring this all back, I believe we discussed this in lesson number 1 and defining our role in lesson number 2 as well of the Become a Pro course. Well, our role as traders, we know that economic data moves markets. We know that. As we go through the features of the most important data points that we perceive to affect markets, our job is always to attempt to properly disseminate news flow and data. Okay. I wanted to make that point clear because we're going to be going through quite a lot of economic data points here. throughout this lesson. I want you guys to really think, to really understand, okay, consumer price index, what does that mean for interest rates? What does that mean for inflation? What trades can I make off? So as we go through all of these particular economic data points, try and really think as a trader, try and develop your skills as a trader to understanding how it might affect some of these assets that you enjoy trading. So again, our ability is to always focus on the data and ask, well, what does the data mean? How can I apply it? Which assets are likely or most likely to move? Of course, if there's very strong or very weak US data, you're going to see more movement, of course, in US dollar pairs as opposed to euro dollar pairs, euro pairs and other currencies. That is certainly the case. And what should I trade for the best opportunity is the answer, of course. So what should you trade for this, for this price move? So let's jump in then to going through a lot of economic data. First and foremost, I'd like to develop on just economic growth and development. In terms of GDP, really, GDP is very important because it's an overall level of gross domestic product. Now, what that means is the value of output produced within a country during a given time. Again, it's quite cyclical. We define obviously a business cycle in terms of recessionary periods and boom periods, of course, which we're currently in. But what I would like to make clear is we understand the current theme, the current environment we are in now when we're trading these markets. Again, all relative to GDP, a huge figure in the markets. You see it sometimes released monthly, and for most economies, they release it quarterly as well. So GDP, of course, in terms of positive GDP, is in fact times of economic growth. That's simply what it means. When output is stronger than zero, we are effectively, as an economy, producing growth. What we define as a recessionary period is 3 quarters of negative growth. So if GDP comes out in quarter 1 of 2019, say for example, hopefully not, of course, quarter 1 of minus 0.4, quarter 2 of minus 0.2, and quarter 3, of course, 2019 of minus 0.6. Just pick a strong figure there. Of course, that has defined to us with quarter 3 of 3 consecutive quarters of negative growth. We are now in a recessionary period, simply defined by the mathematics. Okay. So taking this into account, we know what GDP is. I just want to develop on that. So GNP, something maybe we're not aware of, is gross national product. This is the value of output produced by the country plus net property income from abroad or income from foreign investments. Okay, so GDP plus other value added. Okay, so income from abroad or from foreign investments. GDP divided by GNP per head is per capita. Okay, that takes account of the size of the population. So what is this nominal amount per capita per the population? So what is the wealth effect distributed across the sample of the population, of course? And that is something that is obviously more constructive in relating to growth, literally growth or distribution growth in an economy where you see one of the world's richest economies, Switzerland. How does that relate to Portugal at the moment? Another Eurozone country, of course, or Euro economic area country, I should say. However, is there a severe imbalance there of income distribution? That is certainly the case. So this is another measure that we like to take into account. And real GDP, or GNP, of course, accounts for the difference in price levels in different countries. That's effectively what we're doing, price levels as well. So let's take a moment again just to reflect. I want you guys to really take in the next 45 minutes, 1 hour of this lesson and start to think like a trader. What does each individual element of economic data mean? How may I look to trade it? If I see tomorrow I'm trading across different asset classes and there's one of these figures that is coming out during the course of the day, well, potentially I can use my knowledge to look to trade it. So let's move on then and start with gross domestic product, or GDP for short. Gross domestic product, GDP, is the broadest measure of economic activity in a local economy and is the primary gauge for economic health. Okay, some countries such as Canada are unique in the fact that they produce fresh GDP results each month, while most countries release their own GDP figures on a quarterly basis. Economists use the GDP reference to define whether an economy is in a boom or recessionary cycle like we just discussed there. So what we have here in front and what I'd like to walk through with you is really, well, we have French GDP, and again, it's just dated there to 2016. Now, that's quite a strong level. Were you aware that the total output or level of production in terms of dollar output for France actually totaled a whopping 2.465 trillion US dollars in one specific year? That's the level of overall economic activity there in France in 2016. So that's quite substantial. Okay, quite substantial that you can actually see how these markets are moving as well. And what you can see with the actual contrast here between countries, the United Kingdom again is moving quite strongly in relation to France. We see what this dictates is from 1960 the whole way to relative time. I would imagine around 2016 to 2017 here. Okay, this is just simply put a level of growth or a level of gross domestic product month on month increasing obviously over time as economies grow and new technology becomes available. There's more employment obviously in terms of a nominal rate of employment over the course of the nation. What we can see then again is more relatively in most recent times, Germany is actually outperforming both the United Kingdom and France here. So this is quite important for analysts to look to analyze the German economy, just to say, well, okay, well, we can understand many different factors contribute to the overall growth level. However, what is the GDP? What is the GDP quarter on quarter? What is the GDP for Germany in terms of a dollar value or a euro value in relation to its trading partners and in relation to the size of its economy? Okay, so it's very, very important. What we can see with the chart then is GDP is currently outperforming that of France and the United Kingdom now. Yet, however, all economies are relatively strong. So we're seeing growth. And that is certainly the story since, I'd argue 2009, 10, 11, since quantitative easing started to come in with monetary policy as well. And we're seeing a strong level of GDP growth as a result. So we're finally seeing that reflected in our GDP figures. Unemployment then, moving on. Very, very important indeed, obviously. The change in unemployment is, of course, the main factor for a lot of economies in defining a level of production and is one of the most important figures. So we define unemployment as the percentage of the labor force unemployed or actively looking for work. Unemployment is caused by changes in the business cycle during a contraction phase when businesses lay off workers and the unemployment rate increases. So that's not what we want to see. That's often what you see when companies cannot make substantial revenues. They look to cut costs. It's often a factor of the global economic outlook that the reason why they're not performing so well is because there's a market downturn, and the first thing they'll do is look to cut down on their workforce. That's literally what we can see. That's how close unemployment is related to movements in the business cycle and overall production. On the other hand, then, these workers will find work when the business cycle moves to an expansion phase, and this is the normal function of unemployment. There are many other factors that affect employment rates, and that's certainly the case, but overall it does feed into us as traders when we see a strong figure of unemployment, employment growth, I should say, in terms of the overall level of movement in the economy. So here, a totally hypothetical question. Well, I suppose it's not a hypothetical question. We had this there not so long ago there, just April there, over 2 weeks ago in the US. How significant is a 3.9% unemployment figure for the United States? So we've seen a short downtrend in the news flow, obviously with non-farm payrolls there a few weeks ago coming in as a big miss. However, the total quarterly unemployment figure is at all-time, not all-time, I believe, before 1980, I think, but we're seeing it relatively all-time lows here at 3.9%. Very, very significant there, and obviously rhetoric from the FOMC saying, well, mission accomplished. This is, of course, for real full level of recovery after the financial crisis in terms of the employment levels. So 3.9%, obviously, in terms of the relation or expectation to nominal levels here over the last 6 months, we see it really improving here at 3.9%. So how is the market going to price this in? How are we going to price this in as traders? Of course, this is absolutely fantastic news for the US economy, and we look to trade to the upside, of course, over the long term, given the volatility. Again, US non-farm payrolls. So an absolutely huge piece of news flow in terms of economic data in understanding how the US economy operates and how we can price movements in US assets. Global financial markets view the United States economy as the largest and most influential economy in the world. These markets therefore perceive the non-farm payroll figure as one of the most influential market makers of current growth in the US economy, okay? And that's effectively what we're seeing here on the right hand side. We're seeing the nominal changes month on month in non-farm payrolls. The payrolls figure itself is released in and around the last Friday of each month. So for those traders who are positioning for it, it's always in and around the same time. I believe the last Friday of each month, given that we can land on such a sufficient date in and around 2:30 European Standard Time there. What it outlines is the jobs added to the economy each month minus the farming industry. Okay, given its significance, it's perhaps the most volatile of all economic data figures. And again, we see it each and every month. So it's a great figure to trade. Of course, if you've traded it before, you'll be very aware of how the market can move as such. And again, what we see is big price movements according to expectations, guys. This is what I want to really hit home with you. These are our forecasts. These are our previous figures, and this is what's going to happen. So this is what's going to happen here. This is how we position. Okay, so let's just go through a trade here. So as you can see, we have 188,000 forecast. You know what is likely to happen when we see a beat or a miss. Remember, trading opportunity often arises when the financial forecasts from analysts are either a big beat or a big miss. Okay, these are the best trading opportunities. So let's highlight yet a few. We had 198,000 forecast, 228,000 added. So there's an actual increase of over 30,000 jobs to the upside. That's great for news. That's great for such assets, in terms of equity markets and the US dollar. Let's go through again. We see again another 30,000 beating the expectation. Then we see a huge figure here with 175 to 25, over 40,000 added then in terms of the expectation. Again, some very poor figures. Again, below we have 181,000, and again, we're touching below 40 in terms of a miss for the market. So that's very significant in terms of how these price moves would have actually affected certain assets. So let's take the most relative change, of course, just April 6th there, 2001. How could we trade non-farm payrolls? Very, very simple question, very simple asset here. We have the NASDAQ 100, the technology heavy sector equity index in the United States. If you're familiar with it, we have Facebook, Netflix, we have Microsoft, Google, Qualcomm, Cisco Systems, Intel, huge tech companies in the index. How can we trade non-farm payrolls according to this and according to the real importance of the tech sector in overall economic growth? Again, let us just consult what we see, what is actually released to the market. Well, 188,000 is our effective forecast. We had a very strong previous figure there of a re-advised 326,000. So very, very strong growth in the US. Isn't that great? However, what we see then released to the market is unfortunately very low in terms of the expectation, 103,000. So effectively that is a miss, guys. That is a miss of a total of 85,000. So 85,000 jobs were not added to the US economy that were expected to be added. Very, very significant. So how is this market going to trade? Once we see news flow like this, how do we look to trade this market? Well, simply you could say, well, that is a huge miss. I'm taking a very short-term trade to the downside in this market just to try and capture some momentum. Maybe it will go 200 ticks to the downside. That certainly might be the case given the huge beat. Again, you can trade whatever asset you want, you think that you might find the best opportunity in, but simply trading a fundamental move like this, given the huge miss in that market with the economic data, providing a lot of trading opportunity that you can be aware of. In more relative terms, we can move on to the the European unemployment rate. This measures the percentage of total labour force that is unemployed and is actively seeking employment, and so does not include those unemployed of whom are not looking to work. Okay, so just foregoes that. We can't obviously find a way to monitor that. It is very significant as a barometer to the European recovery story, given we are lagging the US and other economic areas. And that's effectively what we've seen. We've just seen, the non-farm payrolls figure from the United States and looked how to trade it. We've seen effectively the US unemployment figure, how that means in terms of 3.9%, very significant. What about the Eurozone? We're all connected here in Europe now. Obviously, we share a local currency, the euro. That gives us significant information. And what we can see with the chart here is a level of recovery. And again, I've chosen this chart just because it leads from January 2007 up through the recessionary periods with the global financial crises. And of course, evidently the crisis and recovery story is still an ongoing theme in financial markets, but this is what we can see. Well, relative to 3.9% levels, we can see very high levels of unemployment. So again, how is that going to affect markets? How is it affecting the overall business? We've seen the credit crunch was a very unfortunate, obviously, result of the economic crisis. And again, when we're having 10% levels of unemployment, it's very, very significant. And again, that's actually the United States. They're running around 9% there, 8% levels. So you can see how significant 3% is, or 3.9%. We're effectively at these levels now for the United States. Again, different economies are different. The outperformer here is, in terms of a relative change to the financial crisis, is of course Germany, I would argue. Now we have the Netherlands, of course, performing lower in terms of the overall nominal level of unemployment, but Germany seems to be performing quite well. It's trading to the down. It's trending, to the downside in terms of this trend, and actually looking to outperform many of its competitors here in terms of nominal unemployment rates. And again, 2012 was a very harsh time. So let's move on then. We can see how significant this is, and again, we're always thinking of how we can price this into potential trades. Inflation, very, very important economic concept that we must understand. Again, what is it? Well, it's simply a general rise in prices due to a decrease in the value of money. 5 years ago, Coca-Cola cost 90 cents on the euro, where it now costs 120. Or sorry, 120. €1.20. So you can see that the real cost push result in that pricing structure of a simple can of soda there. Inflation is natural and even necessary, but when inflation increases too quickly, it has dangerous effects on the economy, i.e. people cannot afford to purchase needs and wants. And that's very simple. When we see a rising cost of goods and services across the products that we like to buy, well, it's more difficult for us to look to buy them, of course. And again, in terms of the Eurozone, just to reflect on ourselves for a moment, for a long time, the Eurozone experienced large-scale deflation, meaning that the total costs of goods and services were declining in relation to the value of the euro. That was certainly the case. So that was hampering down on a lot of businesses that were trying to outperform. Of course, their goods and services were becoming much, much cheaper. They had to offer them cheaper because there wasn't a strong level of credit or money flow in the economy. Let's go through inflation in its entirety here because it is so important. One of the most difficult side effects of monetary stimulus over such a prolonged recovery period was Eurozone deflation, which we discussed. Why is that? Well, the excessive printing of new money and injecting it into capital markets inevitably leads to too much money supply chasing too little goods. What does this remind us of, guys? If we just discuss and say that sentence out loud, we have inevitably too much money supply chasing too little goods. Of course, that is our lesson number 5 there, where we discuss simple functions of supply and demand. It's very, very important in understanding obviously quantitative easing, monetary stimulus, all of these economic concepts that now rule our markets. And of course, what is the cause and effect of that? Well, at a time, people could not afford to overspend. Simply, they had no disposable income, and money creation was at a high, really. On the other hand, excessive monetary growth, which we are perhaps now seeing it at a factor in causing inflation. Okay, so we see, of course, some very, very positive pushes towards inflation in terms of increasing, how inflation can actually affect us and reduce the purchasing power of our own currency relative to others or services. In terms of the inflation causes here, we have two main causes, of course. What we discussed there was deflationary periods where we see obviously slow economic growth. If we have very large or excessive monetary growth, of course, that is likely to lead to inflation. So let's discuss the two primary focus causes of inflation. We have demand pull inflation. What that means then is when demand for products exceeds the supply, prices rise. Too many dollars, too few goods. This is a natural result of expansion of the business cycle. Okay, so when we're seeing an increase in demand for products and services, we're seeing an increase in currency for those products and services. We are seeing a demand for currency. We are seeing the value of currency be eroded, of course, as those goods become more costly. Very simple. Cost push inflation, when scarcity causes the cost of production to increase, prices rise. Okay, so gas prices increase the cost of fuel for airlines, so ticket prices increase. Okay, so that's effectively a consequential view to seeing how markets, again, I like to discuss them, they're all intrinsically linked. Deflation and inflation again are linked. So if we see very strongly rising gas prices, well, those large companies like Boeing or more locally, Ryanair or something like that, who are in charge of dominating, I suppose, the European flight market, of course, are forced to pay more for their fuel for their planes, and they need to pass this on to the consumer via higher ticket prices. Okay, so that's effectively what we're seeing. Higher prices leads to inflation. Principal effects, of course, prices of goods rise. Of course, the can of soda example. The purchasing power of money is decreased. So perhaps we had 100,000 euros in the bank there 3 years ago. In terms of nominal levels, that 100,000 euro is effectively less money in terms of the purchasing power of what it can buy today. The standard of living declines. More and more households have two people working to make ends meet, and again, fixed incomes are worse affected. So those, those who husband and wife potentially, or partners who are holding down a house but on two fixed incomes, effectively see the value of their fixed income being eroded as inflation increases. People who save money are hurt, and again, I use the example there of your 100,000 euro in the bank. If inflation is higher, that investment loses money year on year, month on month, as inflation increases.